Hey, welcome! Today we're going to demystify something called ratio analysis. Now, I know what you're thinking, ratios sound super dry, maybe a little intimidating, but trust me, it's one of the most powerful ways to understand what's really happening inside a company. So think of this less like a math test and more like a financial health checkup. Ready? Let's dive in.
You know that feeling when you first look at a company's balance sheet? You just get hit with this wall of numbers, equity, liabilities, assets. It can feel totally overwhelming, almost like it's designed to be confusing.
But what if I told you that hidden inside all those numbers is a story? It's the story of the company's past, its present, and it even gives us clues about its future. And ratio analysis? Well, that's the key. It's how we unlock that story and actually make sense of it all.
So, our financial checkup is going to start with the most basic, most immediate question you could possibly ask about any business. Can it pay its bills right now, this month? We're talking about its short-term health, or what the finance pros call liquidity.
And the first tool we're going to use is the current ratio. It's a really simple, elegant idea. All it does is compare the stuff a company can turn into cash within a year against the debts it has to pay off in that same year.
And the formula itself is as straightforward as it gets. You just take the current assets and divide them by the current liabilities. It's a perfect snapshot of what you have on hand versus what you owe, in the very near future.
Okay, so let's make this real. Let's look at an actual example from our source material to see how this works in the real world. So we've got a company, and here are its financials.
First up, we've got its current assets. So that's all its cash, its inventory, everything it expects to collect, basically anything that can become cash within a year. And that comes to 1,34,000 rupees.
And on the flip side, we have its current liabilities. These are the bills, the short-term debts, the payroll, everything it needs to pay off within that same year. And that totals 1,04,000 rupees.
So you do the simple math, divide the assets by the liabilities, and boom, we get a current ratio of 1.29. Now here's the key takeaway. Anything over 1 is generally a pretty healthy sign. It means for every single rupee of debt they owe, they have 1 rupee and 29 paise in assets to cover it. So yeah, in the short term, they're looking good. They're on solid ground.
Okay, so their short-term help is fine. They can pay this month's bills, but what about the bigger picture? Is this company actually built to last? For our next question, we need to look beyond just immediate survival and check out its long-term stability, what we call solvency.
And for that, we're going to pull out the debt-to-equity ratio. This one tells us about the very foundation of the company. It asks how much of this business is running on borrowed money, that's debt, versus how much is funded by the owners themselves, which is the equity.
Think about it like this. A low ratio is a good sign. It means the owners have more of their own skin in the game, which usually makes for a safer, more stable company. But a high ratio, that suggests the company is leaning heavily on debt. Now, that's not always a bad thing. It can definitely fuel growth, but it's a double-edged sword because it means the lenders have more say and the overall risk just shoots way up.
All right, so we've checked short-term survival and long-term stability. The third part of our health checkup is all about efficiency. The big question here is, how smartly is the company actually using its stuff, its assets, to make money?
And a fantastic tool for this is the inventory turnover ratio. This basically measures how many times a company sells its entire stock of goods and then replaces it over a certain period. It's a huge indicator of how well the day-to-day business is actually running.
See, if this ratio is low, that's a bit of a red flag. It means products are just sitting around in a warehouse, literally collecting dust instead of making money. All that cash is just trapped, sitting on the shelves.
But on the other hand, a high turnover, that's what you want to see. It means products are just flying off the shelves. It signals strong sales, high demand, and really healthy cash flow. It tells you this is a business that has some real momentum going.
And that brings us to our final and maybe the most important question of our checkup. Look, a company can be stable, it can be efficient, but at the end of the day, none of that matters if it isn't hitting the ultimate goal. Is it actually making money? Is it profitable?
And the first place we look for that answer is the gross profit ratio. This shows us what percentage of money is left over from sales after you subtract the direct cost of making the products. It's the purest measure of how profitable the company's core product actually is.
Simply put, the higher this ratio, the better. It means the company is making a really healthy margin on every single thing it sells. And that profit is the firepower it needs to cover all its other costs, marketing, salaries, rent, the whole shebang.
So when we start putting all these different pieces together, liquidity, solvency, efficiency, profitability, we're no longer just looking at random numbers. We're reading a complete health report for the company. This becomes your own personal financial toolkit.
Let's just quickly recap that framework. Because it's so simple, all you have to do is ask these 4 key questions. 1. Can it pay its bills? 2. Is it built to last? 3. Is it working smart? And 4. Is it making a profit? That's it.
And that right there is the real magic of ratio analysis. It empowers you. It lets you look at that intimidating wall of numbers and pull out simple, clear-cut answers. It really puts the power of understanding right back in your hands.
So the next time you're looking at a company's financial report, which of these 4 questions are you going to ask first? Something to think about. Thanks so much for tuning in.